Welcome back. We are talking fixed income Friday. As usual, Fridays we normally dedicate to fixed income analysis. And with us here is Renaldo, who is head of research at Sterling Investment Bank and also a veteran fixed income analyst. Renaldo, welcome once again.
Thank you.
We are talking fixed income, and look at your beautiful note, kickoff, 2019-2020 kickoff. You're kicking it off in style. And your projection is that the next week's primary auction of the 15-year bond is likely to come in below 12, just in the range of 12.4 to 12.5.
Yes.
Yeah. What are the key? What has informed this prediction from your end?
If you read the report, there are three things that are going to affect this auction.
Yeah.
The first one being the liquidity in the market. If you look at the interbank rate, it's about it's even edged below 2%.
Yeah.
So it's been ranging between 2 and say 2 and 1.8% over the last 2 weeks.
Yeah.
So there's a lot of liquidity in the market.
Mm-hmm.
The second is trading yields. When you look at the yield curve, the yields have been trading around that level, 12.4 to 12.55. So those are the two main factors that are going to affect this auction.
Yeah, and the liquidity has been quite, the market is better awash with liquidity, and we even see it in the FX market. And we were talking before the show that it's very easy to fund short positions of the dollar. I mean, give us a projection. Do you see this high liquidity in the market persisting, or at some point it will wear off?
I see it persisting in the short term.
Yeah.
The CBK has been trying to mop up liquidity through open market operations over the last 2 weeks.
Yeah.
But I see this persisting at least in the next 2 or 3 weeks.
Okay.
But if it edges upwards, would be still below 3%.
Okay.
On this liquidity, Renaldo, do you have a sense of where it's coming from? And is there any correlation with the demonetization move by the Central Bank of Kenya?
The main reason for this liquidity is government payments. Government are making payments towards the end of the financial year, the 2018-2019 financial year.
Okay.
But also, I think there's a link towards this demonetization. So there's a lot of money coming into the banking system.
Okay.
If you look at the Moody's report released about 3 days ago, they talked about deposits, bank deposits being significantly higher than the loans.
Wow.
Yeah, that means banks are not lending, but
so
there's money
lending,
coming
so
in
they are
as deposits.
sitting. Okay. So then, but you say that the element of this liquidity is probably short term. Is short term between now and December, or is short term up until the government payments are done and that cycle of payments is over, which is maybe another month or so?
I would say the second half of the year. That's between now and the end of the year.
And the end of the year.
Yeah, but shorter term, say in the next 2 or 3 weeks, I was talking about the interbank being between say 2 and 3%.
2 and 3%. Okay, yeah. It's actually gone down. I think it's about 1.99. Do you think it touches 1.5%?
That's
a bit of a stretch.
Yeah, that's speculative, but yes. I can't really tell now.
Okay.
Yeah, but I think the CBK has been stepping in to mop up this liquidity.
Maybe
so it should be about 2%.
Okay, so if I circle up on that, I think looking at the the T-bill auction from yesterday, there's certainly been a gradual decline in rates over and over time. What's your sense of what's happening on the short end of the curve?
So, yes, if you look at actually the whole of this year, the yield curve has been edging lower. One reason is the liquidity, and so there's a lot of money. Banks are not lending to the private sector. Instead, they're buying government securities. So the CBK finds itself in this favorable position where they can reduce the cost of borrowing from the domestic market. Okay. So it's reached a level where we're seeing, say, the 91-day T-bill edging closer and closer towards the 5%.
5%, Renaldo.
Oh,
yes.
That's
5%.
Crazy.
That's scary. So from 6, I think we're about 6.4.
It used to be 8%, but 3 months
91.
ago.
So you can see getting down to 5% in what, in a month? In 2 months?
I'm not too sure when it's going to go that, but I'm saying maybe in the next 3 weeks, the next 3 auctions, we could see a rate of 5.9%.
Wow.
But then you also have to look at it from the investor point of view. At what level will it make sense to invest in government securities or short-term government securities?
Okay.
Because the inflation rate is about 4.5%.
So then at some
So
point,
the real
just
return is almost
there's no return
negligible.
whatsoever. Okay. Wow.
Renaldo, look at your report and your very beautiful check of secondary market activity. It's been very, very strong, especially in the first half of 2019. Let's talk this week. What has been driving, which factors have been driving trading in the secondary market this week?
This week, if you look at most trading has been now on the shorter term end of the curve.
Yeah.
That means, say, 5 to 10 years.
Yeah.
Treasury bonds, those are the most popular with investors.
Yeah.
If you look at it in terms of the whole curve, there's little activity at the long end.
Yes.
Yeah, the long end. Mostly of the investors are looking at the shorter end.
Yeah.
And this with their expectations of interest rates.
Yeah.
There's also a lot of uncertainty as to the direction interest rate caps, the interest rate cap law will take, because there's a court's decision that the interest rate cap
should be reviewed, and the judge, actually it's a bench of judges, gave 1 year for us to review. That's also another thing we've not discussed actually. So I read a while back that the sponsor of the bill, who's Jude Jomo, the Kiambu Town MP and also an ex-boxer, no-nonsense MP, has said that they're actually going to review what the judge said. And actually the judge was all about the quality of the bill, because there are so much ambiguities. Between that and Treasury CS proposal, which one is going to reign supreme?
The final say is with the members of parliament.
Yeah.
They're the ones who make the laws. And yes, the court said that this should be the mandate of the central bank.
Yeah.
But as it is now, it's members of parliament or parliament itself that make up the laws. So the final say is with members of parliament.
Yeah,
and we do not see that
appetite
to
tinker with it. Yes. So you still hold your view that they'll keep the rate cap as it is?
They will, and the extreme case, in my opinion, would be a slight review, maybe increase the margin slightly.
Bides thinks that they're actually going to adjust the
adjustment.
cap.
Yes.
Either with regards to the ceiling, or they may choose to have a different reference point rather than the KBRR or the central bank benchmark rate. They could potentially introduce something different, but I expect an adjustment in one way or the other.
Yeah.
Yes, that's a possibility. There's a growing possibility of that adjustment. In that case, you'd make at least try to appease both the banks.
Yeah.
It might be at the disadvantage of the borrower, but now there's an increasing likelihood of the borrower also accessing credit.
Yeah.
Yeah.
And Renaldo, obviously you privy to the fact that the derivatives market is full. Have you thought, as a thought crept in your mind about fixed income futures?
Our market is still in an infant stage, especially when it comes to derivatives.
Yeah.
Even if you look at activity on the few stock futures we have on the NSE right now, there's limited trading activity.
Yeah.
And even when you look at the fixed income market, there are very few segments of investors are investing in fixed income.
Yeah.
So I think we're still far off derivatives in fixed income futures.
Fixed income derivatives and futures specifically.
That's a bit far off. But just circling in on the fixed income then, if we're far away with regards to fixed income futures, do you get a sense that there could be a change in the operations of the FI market, where CDSC becomes part and parcel of the custodianship of the fixed income assets, as opposed to CBK being the sole custodian of the trades?
To be honest, I've not looked at it from that point of view. Yeah.
Okay, interesting. Because I think for a while the World Bank has actually been doing a bit of work with regards to technical assistance in African debt markets, and trying to see how they could streamline the process and make sure that it's a transparent process where people can be able to see what's trading, what's not trading. Because they keep saying that the lack of transparency actually has an impact on the volumes that you see. So maybe, I don't know, I just wanted to get a sense if you've had anything different from the way we operate, if there are any new initiatives ongoing.
No, I have not. I don't have that view.
Okay, all right.
Yeah.
Thank you for that.
Renaldo, what's in terms of what are you projecting to be the performance rate of this bond in the primary auction next week Thursday? You think it's going to be over 150%?
150% might be stretching it, but certainly over 100%.
Yeah. And how is the central bank likely to behave? Are they likely to pick everything? Because we saw yesterday's Treasury bill auction, they actually picked up everything that was offered. I think they're in a tight corner in terms of trying to keep liquidity in check. Do you still, on that basis, do you still see them picking everything?
I don't think they'll pick everything, but there's a high chance they'll pick, say, at least 90%.
90% of it.
But also look at it in terms of the redemptions. This month, July has the highest redemptions, at least over the last 1 year, 154 billion.
Wow,
in
that's a lot.
That's a lot.
That's
And
a lot.
if you see what has been picked up over the month so far has been about 140 billion.
Yeah.
Okay.
So they are near that redemption value, but there's also that aspect of new borrowings.
Okay.
So I don't expect them to take everything, but they should take a significant portion of the bids.
Okay. But even for asset managers, I mean, if you have this amount of money coming to the system, I mean, how are they likely to deploy this money? Are they still likely to pick up more fixed income instruments, or do you see equity market benefiting from this surge in liquidity?
The question is who's holding the liquidity?
Yeah.
Right now, it's the banks holding the liquidity.
Okay.
Might not necessarily be the
Pension
pension funds.
Yeah.
Yeah. So the banks are holding liquidity, and to them, the most appropriate way of putting this money to use
is to buy more and more treasury bills, and bonds,
and bonds.
Which is kind of a lazy approach to banking today, right? Over the last 3 years.
Yes, it might look lazy, but look at it in terms of risk and return.
Yeah. Which is why I'm always saying that let's short the banking stocks until they craft a very strong growth story for me. I think I'm going to be shorting them. But Renaldo, let's take a short break because the market is just about to close. And when you come back, we're getting to yield curve discussion. See you shortly.